If you've ever heard the terms interest rates are rising or the Fed just made a move and felt confused, you're not alone. Today, we're breaking down interest rates in a way that actually makes sense. By the end of this video, you'll know exactly how they impact you and your finances. Let's jump in. Alright, let's start with the basics. An interest rate is the cost of borrowing money or the reward for saving it. When you take out a loan or have credit card debt, you're borrowing money from a bank, and they'll charge you an interest rate for it. On the flip side, when you put your money in a savings account, the bank might pay you interest for keeping your money with them. So, interest rates affect both your borrowing and saving. Simple enough, right? So why do interest rates even change? Well, it mostly boils down to the Federal Reserve, or the Federal. They're responsible for managing the economy by keeping inflation and unemployment in check. When the economy is doing too well and prices start to go up too fast, aka inflation, the Fed might raise interest rates. Why? Because when borrowing is more expensive, people and businesses tend to spend less, which can help keep prices down. On the flip side, if the economy slows down, the Fed might lower interest rates to encourage more spending and investment. So, what does all this mean for you? First up, loans and credit cards. Higher interest rates mean that any money you borrow will cost you more in interest payments. For example, if you're paying off student loans or using credit cards, a rate hike can make those debts more expensive. But it's not all bad news. If you're into saving, higher interest rates mean your savings account will earn a bit more over time. Now, don't expect to get rich off of savings account interest, but hey, every little bit helps. Let's look at some real-world examples. Imagine you're buying a car. A 2% interest rate on a $20,000 car loan would mean you're paying around $400 a year in interest. But if rates go up to 5%, that's $1,000 a year. This is why interest rates are a big deal when you're making major purchases. Or let's say you want to save up for a big goal like a trip or a new laptop. With a higher interest rate, your savings account will give you a little extra boost. Okay, so we know how interest rates work, but how can we use this knowledge? First, if you have high interest debt, try to pay it off faster when rates are rising. It'll save you money in the long run. Second, if you're saving up for something, try to take advantage of higher interest rates by putting your money in a high-yield savings account. And lastly, keep an eye on rates before making big purchases, especially if it involves a loan. So, there you have it, a quick crash course on interest rates and how they affect your money. Now you're ready to make smarter financial choices, no matter what the Fed decides. If you liked this video, give us a thumbs up, subscribe, and hit that notification bell for more easy-to-understand finance tips. Stay financially savvy.